You're listening to the Decisive Podcast, insights and analysis to empower confident decision-making.
Hello and welcome. I'm Kristen Hallam, your host for this discussion. Emerging markets have been strategically positioned to drive global economic growth. Today, we'll examine the risks of slowing momentum as the macro environment is shaken up by shifting trade dynamics and new trends like the AI revolution. Our panel of experts from S&P Global Market Intelligence will provide insight into which markets are poised to create opportunities for accelerated development. Let me introduce them now. Thea Fourie, Head of Africa Insights and Analysis, Hanna Luchnikava-Schorsch, Head of Economics for the Asia-Pacific region, and Shukla, Principal Economist, European Economics. Let's kick off that discussion now with you, Thea. What do the August PMI numbers from S&P Global Market Intelligence tell us about current economic resilience of developed versus emerging markets? And what can we expect for emerging markets for the remainder of this year and going into 2026?
Yes, thank you for that question. I think if we briefly look at the differences in the PMI readings between developed economies and emerging markets, PMI numbers for the G4, our developed economies, the larger ones, the US, UK, Eurozone, and Japan, still well above the 50 neutral level. In fact, we've seen that the PMI number for US has actually accelerated somewhat in August, and also a little bit of an uptick in the UK PMI number for August. And if you drill a little bit down and looking at the different sectors for developed economies, the services sector, which has really been driving the resilience in these PMI numbers for quite several months. And also what we have seen during August is a tick up in the PMI manufacturing output numbers for the US and also for the Eurozone, now just above the 50 level. And unfortunately, still the manufacturing output PMI for the UK still below the 15 level. Now, if you look at emerging markets PMIs, there's unfortunately a bit of a different picture emerging. And we have seen a slowdown in the output PMI numbers for emerging markets for several months now. And unfortunately, some of the larger emerging markets, such as Brazil as well as Russia, those PMI numbers are now below the 50 neutral level. China just above 50 neutral, but very sluggish, very close. And then, of course, the one really standing out is India. And you see this very nice continued improvement in India's PMI number. So within the emerging market universe, India's PMI really standing out. Looking at the manufacturing output for emerging markets, India, Vietnam still show resilience, whereas there's a lot of other emerging markets, like, for instance, Brazil, South Korea, Mexico, Russia, Turkey, where the output PMIs is now below the 15 level. So, Kristen, we do expect economic activity for emerging markets and for developed economies to start to taper in the second half of this year, going into 2026, which is very much a reflection of this, slowdown in the inventory accumulation due to the tariff front loading. So, this momentum that we've seen during the first half of this year will most likely slow in the second half of this year, having implications for particularly exports for a lot of Asian economies. And the amount of slowdown is really very much dependent on the integration of emerging markets in US supply chains. Regions like, for instance, sub-Saharan Africa, where exports to the US is much smaller, will be less impacted by the direct impact of tariffs. For MENA region, slowdown in oil prices, we do expect less economic resilience because of the lower oil prices. And that really applies for any oil-producing economy, because we do see oil prices to remain very sluggish next year. For the MENA region, however, a rebound in Syria's economic growth, as well as Israel's, could offset some of this oil price weakness. And overall, inflation not yet a problem for emerging markets, and therefore we do expect that monetary easing will continue to support domestic demand for emerging markets, offsetting some of these export weaknesses.
Now, Given the expected slowdown in emerging market economic activity in Q4 and into 2026, what factors could help mitigate the potential negative impacts and leave the outlook stronger than what we currently expect?
Well, Kristen, a lot of this softness in economic activity for developed economies as well as emerging markets, is due to this trade and tariff developments we have seen in recent months. So if we can get some certainty and regarding tariffs, that will take out a lot of these weaknesses or vulnerabilities for emerging markets and the global environment. So if we can get some certainty regarding trade agreements or tariff agreements, that will go a long way in supporting export growth and also maybe reignite investment and really, prop up investment spending. A quick resolution to global conflicts like the Russia-Ukraine war or the Gaza conflict also mitigate some economic weaknesses and again spur on fixed investment and support more economic stability. And then there's also, of course, the technological changes we are seeing. And there's the possibility that some emerging markets could adopt technology and also upskill their labor force that ultimately will support productivity growth in these economies and enhance their competitiveness. But there's also a lot of emerging markets that are doing things right and building their institutional capacity through policy changes. And there I want to really highlight some countries, for instance, in sub-Saharan Africa, which has implemented quite difficult policies like Ethiopia and Nigeria to bring back economic stability. And even South Africa, who's implementing some policy reforms that will place this economy on a stronger trajectory going forward. And then for next year, it is our key theme that there is going to be shoring. And I'm sure my colleague Hanna is going to talk about this more in depth that could prop up some investment and diversify supply chains and ultimately support overall economic activity. So bottom line, Kristen, if we can take out some of these uncertainties in the global economy next year, we probably could see a stronger picture than what we're currently hoping or currently assuming in our baseline.
Hey, thank you for that, Thea. So, the fixed investment landscape remains constrained by rising uncertainty, as you just shared with us, and lack of investor confidence. But are there any sectors that are attracting more investment than others in emerging markets right now?
Yeah, absolutely, Kristen. I think one of the biggest impacts of this trade policy has been the investors standing on the sideline, not only domestically, but also in foreign direct investment. But there has been some sectors in emerging markets that actually performed better last year and continue to attract investment. And the one that's really standing out is digital infrastructure, right? And it's not only about platforms and services, but there's also investment in digital infrastructure and also data centers. And one country that I really would like to mention here is, of course, India, which is really performing exceptionally well in attracting that type of investment. For developing economies, it continues to be centered around the extractive industry, but in many instances around critical minerals. But we are seeing now that the critical mineral development is attracting infrastructural spending as well. Again, coming back to some of the regions that I cover, for instance, in sub-Saharan Africa, looking at the Lobito corridor or the Simandou development that's happening in West Africa and even South Africa with Transnet. So absolutely still the critical minerals remains key to investment. And then although infrastructural investment has slowed down, we still see outperformance in energy transformation for a lot of emerging markets, which continue to attract infrastructural spending. And then there's, of course, always those sectors where, particularly in the Asian region, where you see chip manufacturing, diversification of supply chains, supporting that type of industries, textiles, any type of technology also continue to attract a lot of investor interest. So, yes, emerging markets in those categories continue to be very much watched by foreign investors.
Thank you for that, Taya. Some interesting trends you've identified there. You did make a reference to India, so we are going to pivot now to the APAC region. We will be talking about India as part of that. But first, Hanna, how are we thinking about new pathways to growth in this region? In particular, the ASEAN region has been in the spotlight, and it's benefiting the most from reshoring strategies that Thea mentioned earlier, strategies like China Plus One. Will the latest U.S. tariffs increase focus on domestic value content?
So the short answer to this is yes, but probably not in a way where we'll see a completely disrupted trend. What we have seen in recent years, obviously, is that the ASEAN sub-region has come into the spotlight for the China Plus One strategy, with firms looking to diversify away from mainland China and build alternative supply chains, both for the reasons of rising costs, but also because of rising geopolitical risks. And that obviously has also shifted some of the trade patterns as well as investment patterns, with the ASEAN countries benefiting from additional investment within the China Plus One strategy. If we look at the trade, you can see from the graph here is that actually China's merchandise exports share in total exports has risen significantly to the ASEAN region, where at the same time its share of exports to the US has been gradually declining. And this trend has been exacerbated this year with the announcement of new tariffs initially on China, which also triggered a period of exports front loading and redirection, exacerbating the trend of this shifting patterns in trade. In fact, China's trade surplus with the US has gradually declined, whereas the ASEAN's trade surplus with the US has been rising. And that's exactly what has triggered focus on the ASEAN sub-region for the recent US transshipment. Now, how did the recent tariff announcements, as well as the transshipment clause, meaning that the 40% tariffs would be imposed on goods which are deemed to be transshipped from China to the US, actually impact the outlook for reshoring as well as the outlook for economic growth within the region? And I think here I would identify three biggest aspects. So the first one is the latest announcement of tariffs have brought the tariff rates within the region more or less on par. We are now talking about 19 to 20% reciprocal tariffs, with the exception of several markets within ASEAN, as well obviously a significantly larger import on India, which we'll talk about in a little while. But that means that, after we have this rate settled, we are essentially coming back to the fundamentals of competitiveness of these countries in terms of their labor costs, in terms of their regulations, logistics efficiencies, where firms will start looking again at the long-term strategic decisions where it actually makes sense to set up their manufacturing bases. The second trend here is that with the announcement of this reciprocal tariffs and with the US-China truce holding, and for as long as it is holding, it has now been extended until November, we have come to a lower tariff differential, which might eventually redirect some of the trade which has been coming to the region this year because of this trend back to China. And the third point, which is probably the most important to the region in this context, is this transshipment clause. Again, transshipment has been very loosely defined by the US. And I think what really potentially could be problematic for the ASEAN in particular is that it is not only about complying with the technical rules of origin. It is intent-based, where even if these countries meet the regional thresholds for domestic value added, they might not pass the threshold set by the US. And we identified countries like Vietnam, like Malaysia, and to a lesser extent, Thailand being the most vulnerable. So again, coming back to your question, I think in short, we will see some changes to reshoring strategies, but it will really just raise compliance bar where the focus will shift not just on where you produce, but how much of your supply chain you bring along.
Thanks for that insight, Hanna. I'm hearing there's still a lot of uncertainties there, lots to keep an eye on. So, given the ongoing shifts in global supply chain strategies, are we seeing any signs of greater trade regionalization within the emerging markets in APAC? And if so, what would be the effects of that on the region's outlook, Hanna?
Right, Kristen. So I think again, trade regionalization is not new to the region, and we have already seen a greater integration within the region, particularly within the framework of already existing economic partnerships. In fact, within the region, over 50% of the value of region's trade is already coming from intra-regional trade. And the tariff architecture, which was set by the US this year, will likely only accelerate this trend, with firms accelerating their efforts to build alternative or secondary supply chains within the region. And also with the region itself looking within itself to identify new markets to see where the demand conditions are ripe to set up manufacturing bases to produce in the country for the country. Again, an example of it being India. But this is something where we're already seeing a greater incidence or a potential for increased regionalization of trade within the Asia Pacific region. Now, in terms of trying to quantify the effects of this regionalization, our scenarios team has been building a scenario where, despite the initial negative impacts of US tariffs on trade and on economic growth over the short term, the economies within the region, particularly within ASEAN, are likely the ones to benefit the most from increased trade integration, where their share of trade both within the region and outside the region will rise, and where that would also influence the opportunities for creating additional jobs, the opportunities in the manufacturing sector, in attracting foreign investment, and initially in contributing to the overall economic growth, with, again, Vietnam being identified one of the markets which is likely to benefit the most from this regionalization effort.
Thank you, Hanna. Now, a question that I think is probably on a lot of our audience's mind. What about India? Do we still see it as an emerging markets outperformer in 2026, considering the recent geopolitical shifts and the new 50% tariff on Indian exports to the US?
So I think it would be fair to say that India will retain its spot of one of the fastest growing emerging markets globally, but obviously not without headwinds in the face of the US tariffs, which were recently announced. Clearly, India has now come under the spot because of this announcement. For those who do not follow it closely, they have seen a reciprocal tariff from India of 25% coming in effect in early August, with an additional 25% tariff penalty imposed for purchases of Russian oil. But I think to understand the impact on India, it is important to talk about the three aspects here again. And the first one is the tariff assumptions themselves. Our current working assumption is that it is very likely that the current rate of 50% will come down, probably before the end of the current year. We still see that both sides are interested in trade negotiations. In fact, with both Prime Minister Modi and President Trump just posting on their tweet accounts that both countries are still engaged in trade negotiations and see benefits from concluding such an agreement before the end of the year. So it is very likely that the rate will come at least to only the reciprocal tariff rate of 25%, which is, again, what our working assumption is. The second point here is that, unlike many of its regional peers, India is more isolated in terms of the impact of these tariffs on the overall economy, with merchandise exports to the US accounting to only about 2% of India's nominal GDP. And also, importantly, the tariffs which currently apply still exclude some of the largest export items of India to the US, including pharmaceuticals, including consumer electronics, and semiconductors. These goods remain under the Section 232 investigation, and that excludes about the half of India's exports so far. So, if we talk about the broad economic impact, it is likely to be limited. But that, of course, is not without the risk and not without the secondary effect on specific industries, including textiles, including gems and jewelry, some of the processed foods. And these are some industries that are labor intensive and might have an impact also on domestic demand and consumption. Now, again, if we look at the broader economic picture right now, India's domestic economy remains fairly resilient. We have seen GDP growth now accelerating to 7.8% year on year in the June quarter, which was led also by the strong private consumption. Inflation remains moderate, which will allow the central bank to continue its easing monetary policy cycle. And now the government also announced an additional goods and services tax reform, which should boost consumption. So again, economy remains fairly resilient. We still see potential in India's growth, particularly over the medium term, but we do still anticipate a moderation in India's growth. We currently project real GDP to average 6.2% in the current financial year and recover slightly for the next financial year.
Right. Thank you so much, Hanna. I think it's time to bring Europe into the conversation. So, Shu, we'll come to you next. Concerns regarding the influx of redirected Chinese goods prompted the European Union to reimpose safeguarding measures in strategic sectors like steel and aluminum. Shu, what opportunities or constraints do you see for emerging Europe here?
Thank you, Kristen, for that question. So, just to set the scene a bit before I answer that, the main driver of growth in Central Europe and Balkans, countries like Czechia, Poland, Hungary, Romania, Serbia, and others, is their integration in the EU supply chain, which occurs mainly upstream. And that means that economic activity in these countries feeds further production and exports in the EU. Now, mainland China is EU's largest import market, but there is strategic interest in reducing that reliance for a multitude of reasons, like security risk concerns and other considerations, like not wanting to antagonize the US. So the emerging European producers have a big opportunity here to replace China as the EU's factory. And this prospect has a bigger scope than just replacing or competing with Chinese goods that are being consumed by Europeans right now. So about 6% of total foreign value add in an average EU export comes from China, which makes China the largest foreign trade partner that is involved currently in EU's production chain. Replacing that 6% entirely is a very tall order, and it's very complicated because a lot of it is derived indirectly, which means it's coming from Chinese exports to third countries that are then in turn exporting things to Europe to manufacture with. So for emerging European producers to fully eliminate China from EU supply chain would require them to also replace these products like automotives, like electronics, like mechanical machineries, etc., that are being imported from third-party trade partners. And that would require the emerging to reallocated resources away from production chains where they currently have a competitive advantage, like high value manufacturing. So we published a report that estimates the cost of reshoring this Chinese production ecosystem. And long story short, the numbers add up to about 13 million new jobs and about a doubling of current investment levels for a decade or more in order to produce about $1 trillion of additional output just to keep the EU supply where it is right now. That is not going to happen. But even with less than full replacement, there's plenty of reshoring opportunities here for emerging Europe.
Thank you, Shu. Some big numbers there. And how does the EU's recent trade deal with the US play into that? Which economies and industries in particular would you say are best placed to make these reshoring gains in Europe's eastern edge?
So the bottom line is that the strict rules of origin that US is applying in its trade deals is likely to act as an additional tailwind for bringing more of your supply chain in-house. The US EU deal in particular sets a 15% final duty on most US imports from the EU, which is on the lower end of tariffs that the US has imposed on its trade partners. But in order to qualify for that tariff discount, so to speak, the product needs to be European enough. So, like in the ASEAN case, as Hanna mentioned, this is likely to operate as a relatively high regional content value requirement, or in simpler terms, just making sure that the product is local. And the key here is that, unlike the ASEAN case for the EU, this is likely to apply for the entire bloc and not for each individual member state separately. So, what that means in practice is that you could still have some intermediate production in Czechia that then gets exported to Germany and used in its manufacturing to produce a product, let's say autos, that is then sent to the US as made in EU. And this is a key detail because, on average, about 60% of an EU member state's participation in the global value chain occurs from trading within the bloc. And from the US perspective, that does not dilute the Europeanness of the final product. Now, the Central and Eastern European member states, Czechia, Hungary, Poland, Romania, they all are viable reshoring destinations because of their specialization in high skilled manufacturing, their well-developed trade and distribution networks, their proximity to Western European markets, and also their relatively low operational risks than the non-EU peers. And these reshoring benefits are likely to accrue in industries where there is both comparative advantage today and also spare manufacturing capacity to increase the volume of output. So industries like mechanical machineries, like automotives, electronics and electricals, parts and accessories. But on the other hand, for labor intensive production like clothing and textile, and also for energy intensive industries like chemicals, the relatively higher cost of producing in Central Europe versus, say, Asia still acts a deterrent for reshoring interest because enough of this product is local already. So the threat of a transshipment penalty from US doesn't really overcome that cost disadvantage.
Thanks for that, Shu. So, are there any other growth pathways that you're tracking in Europe that aren't related to trade? Which European markets have bolstered their competitive advantage, would you say?
Yeah, so a new growth impulse that we've been tracking for emerging Europe is from higher defense spending under the new NATO target, also motivated by concerns about weakening US commitment to European defense and by the security threats posed by Russia. So since 2022, Europe has significantly increased its imports of arms, and many NATO members have already committed to increasing their defense spending even further, most notably the large off budget infrastructure and defense funds that were approved in Germany earlier this year, and also the 800 billion euros Readiness 2030 joint fund that has been proposed by the European Commission. Now, emerging European member states tend to benefit more from joint funding because they lag the most in economic convergence with EU standards. And for the non EU Balkan states, Serbia, North Macedonia, and others, the increase in defense related demand in Europe provides a market to redirect their dislocated munitions exports that are currently a big part of their trade offering to the US. Then looking at the structure of defense spending currently, the highest category is on spending on personnel, and an increase in that has a significant multiplier for domestic demand, which is boosted further for certain emerging European member states that are, deeply integrated into the German economy. So the Visegrad states of Slovakia, Hungary, Poland, and Czechia, because an additional unit of demand in Germany produces returns for their own growth. And then lastly, I would say that in the past, spending on research and development in the defense sector has led to technological advances for the commercial sector. So, for instance, the development of satellite communications technology, which was initially only for military use, later became the basis of GPS navigation systems. And then separately from defense, I also would like to mention Bulgaria, which stands out as a climber in our strategic opportunity index, which scores and ranks about 100 markets on 40 indicators of market potential and performance. Bulgaria was given full accession to the Schengen area in 2025, which increased its integration into the EU business cycle. And it has also been approved to adopt the euro in 2026, which would then lead to it obtaining a hard currency status and unhindered access to ECB's refinancing lines, essentially eliminating any liquidity or foreign exchange related risks. And if we compare Bulgaria's SOI scores with Croatia, which was the last country to adopt the euro, an area of improvement that jumps out is policy favorability. And so what it is suggesting is that Bulgaria can improve further its strategic opportunity position if, following the euro adoption, the Bulgarian government is able to pass structural reforms that would reduce legislative delays and policy impasse.
Thank you for that snapshot from our Strategic Opportunity Index there. So now we're going to pivot to a discussion of AI. So, how much of an impact will technological changes have on the growth stories of emerging markets' economies? Are some of these markets in a better position to take advantage of this trend? Shu, since you're already in the hot seat, let's start with you.
Yep, sure. I would say that's a really broad question to answer because, technological change can mean so many things, everything from greenification of physical infrastructure to automation of value chains. But if we skip that detail for now, the question to ask is whether technological change can improve European competitiveness. And that is a question of interest, not just for us, but also for the European Commission, which sponsored the Future of European Competitiveness report last year, authored by a former ECB president, Mario Draghi. So in this report, Draghi argues that the way to boost European competitiveness is to bridge its productivity gap with the US and with China. And the way to do that is by investing a lot more in innovation and technology. This is an argument of capital deepening, where output per worker is increased by better technology, which makes capital more productive. And the analysis done by our scenario team shows that if all of the policies and reforms that are proposed by Draghi are implemented, then there is a boost to European economic growth that comes from, savings being transformed into high-yielding investments. But crucially, this economic boost concentrates more in the emerging European member states because these countries start from a lower economic base. So any additional investment produces higher returns when you compare that with the advanced economies in Western Europe. Now, this, of course, is a best case scenario, so to speak. And 1 year on, since the report was published, only about 1 in 10 of Draghi's recommendations have actually been implemented, with the lagging areas reportedly being digitalization, clean tech, and energy. And there are likely many factors that are slowing execution. And a key one to highlight from me would be the fact that the necessary technology is not always free flowing. So, for instance, Central and Eastern European states have vast deposits of critical minerals, which, according to Draghi, are important for securing Europe's future. But these regions lack the processing technology, which means that EU currently still relies on China for these supplies. And one of the key conditions from the EU side for any rapprochement or agreement with China is sharing or transferring technologies in sectors like EVs and battery production. But China hasn't really been very keen on that so far.
Right. Thank you for that. Now I'm going to pose the same question to you, Hanna. How much of an impact will technological changes have on the growth stories of emerging markets economies in your region? And are some in a better position to take advantage of these trends than others?
Thanks, Kristen. So I think just as Shu already alluded to, that the question of technological advancement is very broad. And obviously, there are many aspects of it which will have an impact on economic outlooks for the emerging markets, including the impact of artificial intelligence on productivity, on labor markets, on wages and negotiating power of workers, also on emergence of entirely new industries and sectors, including data centers and some sensitive defense technologies, as well as the roles that the fintech is already having on access and the cost of financing for some of the emerging markets and their domestic firms. But I think one of the common themes here is that adopting new technologies for emerging markets is also an issue of capital and receiving that additional capital. And foreign investment can play a big role in accelerating technology adoption and penetration for emerging markets. Again, something which Thea already alluded earlier while answering questions is that foreign investment has been critical also in AI adoption, in establishment of data centers. And what stands out here for the emerging Asia is that indeed it has been among the largest recipients of foreign direct investment in technology sector. So greenfield investment in technology sector among emerging economies is fairly concentrated. About 80% of FDI inflows in the sector in emerging markets is concentrated in the top 10 recipients, and 7 of them are located in Asia Pacific region. In fact, India is receiving about a third of all foreign direct investment in technology sector by the number of projects, and almost 40% by the value of that investment. So I think when we talk about the impact that the technology adoption will have on emerging economies, Asia Pacific region stands to be among those benefiting the most from the resources provided to adopt, and that is likely to really help it reap the benefits from technology advancement going forward. It is also not surprising that 40% of all startups are located in the Asia Pacific region in emerging Asia.
Right. And then, Thea, same question for you. How much of an impact will technological changes have on the growth stories of emerging markets in your region, Africa? And are some of these markets in a better position than others to take advantage of this trend?
Yeah, so Kristen, I think my colleagues has really highlighted all the the benefits and the risks to all of this, but I would like to broaden the discussion maybe beyond just emerging markets and look a little bit at frontier markets, which is also very much close to my heart as well. And I think what we need to be cautious of is not to widen the digital divide, due to these technology changes. And it's not only about having access to the technologies, but we're also talking about having access to electricity, having access to the internet, have to have your labor force being upskilled to adopt these type of technologies. So I think frontier markets this is an enormous opportunity for them, but it's really focusing not only on adopting technology, but also looking at those constraints that, could widen the digital divide. I do, however, want to mention one very huge potential, and Hanna, mentions the fintech sector and the emergence of stablecoin and how that can change the cost of financing, cost of funding across borders, particularly regarding remittances, but how that also can change the cost of trade across borders. Opportunities this means for, again, regionalization, the steps that needs to take to develop the African Continental Free Trade Agreement and enhance, industrialization and improving the employment conditions for low skilled workers or unemployed workers on the continent. So it's a huge opportunity, but I think we have to be cautious that it does not result in a further digital divide that has been, problematic in the past.
All right. Thank you for that, Thea. And that is all the time we have for today. Thanks to Thea, Hanna, and Shu for sharing their insights with us. And thanks to you for joining us today.
Thank you for listening to the Decisive Podcast from S&P Global. Please subscribe and join us for next week's episode. Until then, stay curious and stay informed.